It gives me great pleasure now to bring on board Mahesh Nandurkar of Jefferies India to talk about their conference, way forward for Indian equity markets, how should one read into the Fed 50 bips rate cut, and essentially in terms of the sound bites from corporate and mood point from global investors, how are things tracking? Mahesh, compliments on this fantastic conference. I have some friends who've come from I've got friends who've come really from all parts of the world just to attend the Jefferies conference in India, and I've been told that the session of speakers included Mr. Birla, Mr. Jindal, cabinet ministers. What a stellar show it's been. Sincere compliments.
Many thanks, Nikunj. And yes, it has been a great conference to host. We had a very strong participation, as you rightly mentioned, from very senior leaders from the corporate side, senior leaders from the government side, and a very, very strong participation from the overseas investors and the domestic investors as well.
Mahesh, so what is the big, understanding of how things are shaping up for the economy and for India Inc. Based on your interactions, both on the record, off the record, inside the conference room, outside the conference room, how is the growth and the earnings picture stacked up?
Yeah. So I believe that the economic outlook for India is definitely fantastic, and the reason why we have that confidence and continue to get that confidence reinforced is when you look at the investment activities in the economy, the fixed capital formation is rising, and it's always investments-driven growth is more sustainable. Investors like it. It broad bases the market, creates more options and opportunities. And also in the context of what's happening globally, Nikunj, where we are seeing growth in China being quite weak, US is slowing down, and there is some probability now that is getting assigned to US recession as well. And that's why the Fed is cutting and so on. So in all that context, the relative position of India is looking even better. The absolute numbers are good. The relative positioning is looking even better with 6.5%, 7% GDP growth outlook, 12 to 14% corporate EPS growth outlook, and that too over a long period of time. So investors, have really, shown a lot of interest, which shows in the numbers that we've been able to pull. We got investor participation from 20 different countries, which is the widest participation that we have ever received. So that goes to show the foreign investor interest.
Mahesh, if one really looks at last 2 quarters, we've seen not too many big upgrades, couple of downgrades, and in general, markets have not seen any big earnings surprise. Are we in for more of the same? Where based on your interaction with companies and your understanding of demand and growth dynamics, we could be in for perhaps two or three lull and dull quarters of earnings?
That is quite possible, Nikunj, because we've had a very strong growth over the last couple of years. This year, yes, we have seen some earnings revisions on the downside. And the June quarter, the attribution that was given to was the election-related activities and hot summer, etc. This quarter, it seems like the rains that have been higher than last year have had some impact. So there are a couple of reasons like that, but the end result is that probably we are going to be seeing some earnings revisions on the downside. But as I said, having said that, the growth numbers are still looking reasonably good. The key question here, Nikunj, is that when we talk about the growth outlook being good and relative positioning being strong, etc., how much of that is already factored, by the market? My sense is that the strong surge in the domestic liquidity has made the markets quickly factor in the growth outlook that we are talking about. So maybe a couple of quarters, 2, 3 quarters of market moving sideways, or maybe a small dip, etc., is quite likely. And if that were to happen, I would actually take it as a healthy time correction, because the earnings growth, as I mentioned, is about 14% or so. So even the market remains flattish for the next 1 year, the valuations improve by 14%, which would then begin to look more attractive.
But the bedrock on which markets are going up is this insatiable appetite for equities, whether it is retail, HNI, or even global investors. But in your recent strategy note, which is 13th of September 2024, the the observation what you are making and what you essentially are making a case is that unsustainable demand flows a challenge, which means are you making a case that the kind of liquidity which is coming from domestic investors and domestic participants into Indian stocks will not sustain?
See, if you look at just the macro numbers in this current calendar year, 2024, for 8 months for which we have the data for, the the average domestic inflows into equity markets been at $7.5 billion a month. The good part is a dominant part of that is coming in by way of mutual fund flows, but still the absolute number of $7.5 billion is huge. If you were to annualize that, we're looking at $90 billion per year kind of an inflows. And that accounts for about 25% of gross financial savings, about 35% of net financial savings. Now, these kind of percentages, 25 or 35%, is something that we see in developed world. So clearly, to that extent, I believe that the flows that we're seeing are at an unsustainably high level. And there is a good possibility that we trend down towards a more sustainable number, say around $4 to $5 billion. So yes, I am making a point here that the domestic flows at the current pace appear unsustainably high.
If your thesis turns out to be a reality, then what happens to the market demand supply dynamics? Because one side IPOs are simply going higher and higher, and if flows are unlikely to sustain, could be then be in for a demand supply mismatch. It could be technical in nature, but are we headed there?
See, the technical, nature or the short-term nature, while that can unfold, but at the same time, we also have to keep in mind the foreign investor positioning on India, which is at the lightest level that we've seen in the last 10 years or last 15 years or so. And that's also because the neutral weight of India has gone up quite a lot, and several of the foreign investors have not been able to keep pace with the new stock, the new sectors being added, and they are looking at opportunities to buy the market on any potential dip. And that's clearly the feedback that we get from interacting with a whole bunch of investors here at our conference. So my sense is that while there could be some toning down of domestic flows over the next few months, but any big market correction still looks unlikely to me because there is a large pool of foreign money also waiting at the sidelines.
Whereas the general view was that Fed will cut rates and FIs will come back. Do you see that happening now that Fed has gifted everybody with not 25 but with a 50 bips jumbo rate cut? Do you see liquidity coming back in a hurry and in abundance back to emerging markets like India?
Yeah, that is our base case, Nikunj, that the rate cut undertaken by the Fed will drive incremental monies into the emerging markets. I mean, you would remember that emerging market as an asset class over the last 5 years or so has been completely neglected. And that is also one of the reasons why why we have not seen much of foreign inflows into markets like India, despite being so attractive, from growth perspective, etc. So my sense is that things like rate cut by the US Fed will be a trigger for many of the global funds to increase their allocation to emerging markets. And clearly, India being one of the best performing emerging markets would draw its share of flows. So that is clearly our base case.
What is your understanding of the demand side, which is IPOs, QIPs, block deal by promoters? Do you see that becoming a challenge? Because, you know, bankers always tell us that they advise their clients that you should raise money not when you want, but when markets are hot. And right now, markets are hot.
True. So what we're seeing is that if you're doing the analysis of equity supply or the corporate issuance of equities, about so in the first half where we have done this analysis, we have seen almost 33 to $34 billion of funds being raised by way of either block deals or by promoter sale or by IPOs and QIPs. Now, out of that $33 billion that we've seen, almost one third of that is fresh equity raising, meaning that the money going into the corporates or going into the companies for future growth. Whereas the balance two-third is actually by way of private equity selling down their stakes, or even in certain cases, promoters selling down their stake, or certain large block deals happening. And this two-third portion is clearly, to some extent, opportunistic, although some part of that is being used by the promoters to deleverage their own balance sheet and reinvest for growth in some other entities. But private equity investors are kind of, repatriating this money back home. So the point I want to make is that yes, IPOs and QIPs is only one-third, but two-third of the money that is being raised from the market is more, more, I would say, opportunistic, in that sense, what you mentioned. And that supply of paper is demand dependent. Because we have seen very strong demand coming in, the supply has responded in that way. But if for whatever reason the demand for equities were to come down, I think it's that part of the supply that will go down the first. IPOs, QIPs might get impacted, but that is not that big a part of the paper supply anyway. So the point is that yes, if for whatever reason we see flows going down, then that will definitely have impact on the market. But I think IPOs, QIPs can still go ahead. I think what will be the first casualty, in my view, will be these block deals and the PE exits and the promoter exits, etc.
Well, of course, in moments from now, Chris would also join us, will also join us. Mahesh, so I'd like to draw your attention to what's happened suddenly in the PSU stocks. The real poster boys, the leaders of this bull market, they've suddenly reversed. On an average, PSU stocks are down 20 to 20%. Defense stocks, railway stocks, shipyard stocks, they've even taken a bigger hit. They are down on an average 30% from the recent high. Do you think the happy hours in some of the PSU stocks, is that over now?
See, once again, I would attribute this factor to the flows. And I think one needs to pay real deep attention to flows these days, because that is one of the dominant factors impacting the stock price movement. So the thing is, while I mentioned that number of $7.5 billion, etc., if you look at the composition of that, that has changed over the last couple of months. We have seen, I mean, in the first half of the current calendar year, we saw a significantly larger portion of those flows coming in by way of single stock investments by the retail investors, by the HNI, or by the AIF, etc. And that has changed over a period of time. And over the last few months, we've seen the single stock purchases have gone down, and more of the money is coming in by way of mutual funds. So, and I believe that a large part of the single stock purchases were going into many of these PSUs and defense stocks and railway stocks, as you are pointing out to. And that slowing down has had impact on some of the stocks there. And I believe that given how strong the rally in many of these stocks had been, prior to this cooling off that you're mentioning, I believe that you could see some further consolidation in some of these segments and some of the industrial segments. And that's also one of the reasons why we have been making changes in our model portfolio as well for the past couple of months, where we've been taking down weight on real estate and industrials and mid caps and small caps, and some of the select PSUs as well. So I think, yeah, this phase of consolidation can go on for some more time.
Chris Wood also joins us now. It's always a pleasure to have him on ET Now. Chris, welcome to India. Uh, Chris, let's start with the global news point, which is that instead of 25, Fed has done a 50. They've surprised everyone with a jumbo rate cut. Do you think this was largely driven by political compulsions, or this is Fed's understanding of the economy in terms of where it is headed?
Well, I have to say, Nikunj, I personally was surprised that they cut rates by 50 basis points simply because of the language employed by the Fed going into the meeting and the data, because the data was not weak enough to really make one think they're going to cut by 50 basis points. So yes, in the absence of any other explanation, I would have to say you do wonder if there's a political element to this 50 basis point rate cut move. Now, in the big picture though, what they do in one meeting is not that relevant. In a world where the US achieves the hoped for soft landing, I think we should assume that the federal funds rate could be at 3.5% by the middle of next year. And in a world where the US economy weakens more significantly, it will end up lower than that. But this move this week is a surprise, given the language employed by the Fed chairman going into it, given the fact that the Fed is still describing the economy as being basically fine. So yes, I am surprised.
So in hindsight, when we will analyze the surprise rate cut by Fed September of 2024, do you think we are likely to applaud Fed for cutting rates and saving the economy from a hard landing, or this surprise rate cut in a sense could be a fuel for inflation to come back?
Well, I think there were many people arguing that the Fed should already have started cutting. So people like former New York Fed Chairman Bill Dudley's been saying the Fed's behind the curve. So there's a perfectly respectable argument that the Fed was behind the curve because the labor markets, in classical economic terms, is viewed as a lagging indicator. And so, this Fed's been paying particular attention to the labor market. So I'm basically surprised given the stance adopted by Powell and the Fed in recent months. And obviously there will be people saying it looks political because of the timing. And from an objective standpoint, it does look a bit political. But ultimately, it's only one meeting. And as I say, what matters is the direction of rates. And I think investors should assume, even if they believe in the US soft landing, that the Fed funds rate will be at 3.5% by the middle of next year and lower if the economy weakens more. On the US economy, this is a very difficult cycle to read. India is much more straightforward. It's going to be growing between 6 and 8% real GDP growth. The US economy has been extremely difficult this cycle. There's been a lot of weird dynamics created by the pandemic. I still believe there's a risk of a more pronounced downturn because the M2 to nominal GDP ratio, which went way above trend in 2020 on the money printing, has only just broken below the long-term trend line on the downside, the trend line from 1997. So that's a complicated way of saying that the tightening in liquidity in the US economy as a result of this Fed tightening cycle has only just begun to bite.
Chris, the differentiating factor this time, of course, is China. Last time when Fed was cutting rates, China was consuming. Right now, Chinese appetite has come down, and that in a sense will have serious implications in the way how commodity demand would move. So how do you see this rate cut cycle impacting commodities in general?
Well, yeah, it's been interesting that the commodities, and it's interesting in many ways that the commodities have not been weaker, given how the very depressed data out of China. So I think another key variable for commodities will be the dollar, and my bias is that the dollar has commenced a weakening trend. The dollar is already down quite significantly from all-time highs against Asia and emerging market currencies. It's down quite significantly now against sterling. A lot of people were looking at the dollar vis-a-vis the yen, but even there it's now down a bit. So fundamentally, I think the dollar has begun a weakening cycle, and a weaker dollar is positive for commodities.
Chris, you've always...
so that should, in some respects...
Please carry on.
No, all I was saying is, all I was saying, Nikunj, is that a weaker dollar tends to go hand in hand with stronger commodities, so that should counterbalance the weakness we see in China. But the Chinese economy is undoubtedly weak, and it's best captured in the fact that nominal growth in China continues to run below real GDP growth, and that weakness in China is reflected in record low Chinese government bond yields.
Chris, I'd like to take the clock back and remind our viewers that we interacted with Chris Wood a day after the election, and Chris was clearly of the view that the India story will be alive and kicking. So Chris, what do you make of the first 100 days of policy action of Modi 3.0?
So I missed the question, Nikunj. What
Yeah,
first 100 days
of Modi 3.0. What do you make of the policy action?
Well, the impression I've got from meetings and discussions with people in Delhi this week and related to the government is that there's less of focus on passing new laws and more of focus on deregulating and trying to well, you might call it a bonfire of the legacy of the license Raj in terms of all the permits, regulations, restrictions. So people clearly want to do a big deregulation to make it easier for businesses to prosper. So that's the impression I'm getting from this week. Huge focus on deregulation.
Chris, for the longest time, you had raised concerns about the private sector capex and the fact that the cycle had not started on expected lines. But in your recent visit, and now that you've interacted with a lot of corporates on the sidelines of the Jefferies India conference, what is your view on the private sector capex cycle in India?
Well, on that point, I think it's very straightforward. Mahesh was probably, you probably had this discussion already with Mahesh, but we are firmly of the view that the private capex cycle is well and truly underway. So at the previous Jefferies conference in India 15 months ago, we were making that case, and we thought it had already commenced, but there wasn't really there was less clear macro data to endorse that view. The best signal that the capex cycle and the private sector capex cycle was commencing was the fact that the capex stocks were rallying. But 15 months later, there's clear evidence in most sectors of a pickup in private sector capex, and that is the key reason to remain bullish on the Indian stock market from a medium-term basis. So the way we look at it and the way I look at it is that the government capex cycle building infrastructure in the last several years has created a backdrop or a framework which is now enabling a deleveraged private sector to take over the baton of the investment cycle, if you use the analogy of a relay race. And this is now clearly happening, and it's extremely positive. The last time we had a private sector capex cycle in India from the 2002 to 2009 period, the Indian stock market dramatically outperformed in an Asian context, and that's been the case so far, again this time. And obviously that capex cycle is on the back of a 4-year upturn in the residential property cycle, which we also believe will continue.
Chris, 2.5 years ago, when we interacted with you, the interview was on a different setting. It was the ET Now office. And you were amongst the first one who came out with a clear, loud, and a convincing buy call on consumer tech companies like Zomato. And from 50 rupees, Zomato has gone to 300 rupees. Other consumer tech and fintech stocks have also come back. Where do you think that group in India is headed? Consumer tech, fintech, this entire technology-driven basket, so to speak?
Now, all that area remains very interesting, dynamic. Obviously, the key issue in that area is the bottom-up issue of who's going to prevail. But that whole area is not going away, but it's a question of the winners and the losers. Because in that particular area, you do have a tendency for winner-takes-all dynamics.
Chris, you've always liked Indian financials and especially private banks. Now that the rate cut and its effect on liquidity would kick in, do you think there is a strong case for private banks in India to outperform?
Well, I know. To me, the private banks, or indeed the IT services companies, are kind of the low beta areas of the portfolio. So, in a world where we get a correction, these sectors will be, in my view, outperform. But I think the drivers of this current bull market we've been in have been more in the energy, infrastructure, real estate area, and my guess is that these remain the key drivers of the story. But clearly the banks are overdue some outperformance. The banks have also had a bit of a regulatory headwind because the RBI has been quite preemptive in terms of regulatory initiatives in recent months, which in the short term is negative for the banks, but in the long run it should hopefully be positive because it means that the credit cycle should be maintained for longer without disruption. So I'm maintaining banks in my greed and fair India long-only portfolio, but I'm also maintaining the more high beta areas like capex, real estate, energy.
Chris, you've been calling out the bull run in the real estate cycle for a while now, and you're still maintaining that the real estate cycle in India will remain in an uptrend. What gives you this conviction that real estate cycle in India is an uptrend, considering that real estate prices on an average in last 3 years in India are anywhere up between 50 to 70%?
We're probably due a bit of a pause to refresh in the property cycle, but in the big picture, we've entered the 4th year of a recovery after a 7-year downturn, and during that downturn, real estate prices went up less than income growth. So my view is there's huge pent-up upgrading demand. I believe the inventory in the top 7 cities is in a multi-year low. So what should happen is that the property recovery should gradually broaden out in terms of it's been led by the high end. That's what normally happens. And hopefully that's what normally happens in a property cycle. The high end leads the recovery. And hopefully we should get some rate cuts in India in the next 12 months, and that will cause property to become more affordable in price levels, lower price levels, such as below the equivalent of $200,000 for a unit. So I'm hearing 500,000 property sales projected in the top 7 cities this year. Basically, the amount of properties being bought in India is still very low, what we've seen in China at the peak. So I think right now, I think we should hope that the property cycle can run another 4 years. We're just entered in the fourth year of this upturn. I don't see any reason why it should suddenly finish.
Chris, allow me to zoom out a bit and take it back to global events. And the next calendar event, which in a sense could have an impact on financial markets, is the US elections. It's going to be Trump versus Kamala Harris. What do you think is up ahead for us? And what do you think Wall Street will like, and what do you think Wall Street may not like, depending on the outcome of the US election?
I think the single most important factor in this upcoming presidential election is that there's a decisive winner. I think that's what the market will most want to see. The worst thing for the market would be a disputed election result. So that would be my first view. For the moment, the polls remain quite close, but they are in Kamala Harris's favor. From an equity market standpoint, A Donald Trump victory would be more risk on because he's going to be very pro deregulation. He's going to be wanting to extend tax cuts, and he's going to be wanting to increase energy production, which could lead to a weaker oil price. So he's going to be more risk on, whereas I think Kamala Harris would be more status quo. Probably the biggest difference between the two candidates in domestic policy would be in the energy area. But I think the key point for the market is that there's a decisive outcome.
Chris, what do you make of some of these global powerful themes? For example, EV, energy transition. These are two large themes which are now widely debated both at government level and also at corporate level. And given that what's happened to some of these EV and energy transition related stocks, where do you think these two mega trends are headed, and can investors still make money by betting either on EV stocks or by energy transition stocks?
Now, the energy transition is happening. The problem is that the energy transition story got kind of in some ways distorted by the ESG theme and the green political movement, and it suddenly became fashionable to adopt these race to zero targets. In the UK, they had some very ambitious target for stopping ICE cars, and there's been a rethinking of this because obviously a lot of these targets were proven to be wholly impractical. So the simple point is if the renewable story is as good as its proponents make out, such as the solar story, then it's going to happen because it's going to become competitive because it's going to be cheap. We don't need all these forced agendas. And clearly in India, there's an understandable huge focus on renewable investment to reduce the dependence on imported crude. But at the end of the day, India is going to need to consume all the energy it can find, as is China. So it's not either or, it's everything.
Chris, I know you got a packed day ahead, so I'll just limit it to just 2 or 3 final questions. In your current model portfolio, your India weightage is 20%, which is in and around the benchmark. Now, you like India, and there is merit in why Indian stocks or Indian economy should occupy a pedestal positioning. But any specific reason that your India recommended exposure is in and around the benchmark or marginally overweight?
Yeah, so in my relative return portfolio, Nikunj, where I'm running portfolio on a relatively short-term tactical basis relative to the benchmark, I'm running India marginally above neutral. And the key reason for that is that India's neutral rating has increased dramatically, which is also why we believe global emerging market investors are now a little underweight India. But in my long-term or my more long-term orientated global portfolios, I have much bigger weightings in India. So my Asia ex-Japan long-only portfolio, which is about 25 concentrated stocks, I'm still nearly 50% invested in India. So this neutral weighting is just a tactical call, given we've got very high valuations, and it would not surprise to see more of a correction of the type you were discussing in the SOE stocks with Mahesh. The key point, though, is that if there is a correction, foreigners will view it as a buying opportunity because, as we've discussed, they're underweight.
Chris, my last but one question. You being a big votary of domestic savings moving into equity markets, and in our last interaction also, you were pretty clear in your messaging, and you were of the view that domestic flows into India will continue for many years now. This is a multi-year trend. Would you still endorse the same?
Oh, no, I continue to have that view, and this is extremely bullish development. And what's most bullish is a lot of these flows through the SIB schemes are incremental. And so that's extremely healthy because people are not investing all their money at one particular time. So I think this is extremely healthy development. There's clearly growing belief in the long-term Indian equity story on the part of Indian households. We believe they have now 6% of their assets in Indian equities. And the best testament to that long-term belief is that the recent surprise announcement of the increase in capital gains tax did not have, to me, a surprisingly little impact on the stock market.
So Chris, my final question. What is Chris Wood's market view? Short-term market view, medium-term market view, and long-term market view?
You're talking on India, Nikunj?
That's right.
5 and 10-year view, I still believe India is the best stock market best stock market opportunity in the world. On a short-term view, in a short-term view, India is not going to be the short-term flavor of the month because we've begun a Fed easing cycle, and the other emerging markets, such as Brazil, is a good example, who are more geared into declining U.S. rates.
I'm just tempted to throw in one more question, pretty much on the similar lines. Let's now identify trades based on time horizon. Which is one trade you are bullish on, tactical trade, in the short term? Short term when I say 6 months. Which is one trade you are bullish on for medium term, which is 1 to 3 years? And which is one investment you are bullish on, which is for long term, 3 years plus?
So what was the first one? 6 months.
6 months, 1 year, 3 year plus.
My trade 6 months. 1 year, 3 year plus. No, 6 months I would be actually, owning gold. 6 months I would be owning gold mining stocks. Gold has gone up a lot. Energy is at the bottom end of the range. The profit margins of gold mining companies should increase significantly, and so far gold mining stocks have been underperforming gold bullion.
And medium and long term also, Chris. Before we wrap, I'm tempted to again perhaps prompt that question again.
My long-term recommendation to anybody listening would be to sell US Treasury bonds.
All right, Chris. Really appreciate your time. Enjoy your stay in India. And it's always a pleasure to have you on ET Now.